Welcome back to the Deep Dive. Today, we're cutting through some of the complexity around financial compliance. We're diving straight into the UK's framework against illicit funds, anti-money laundering, or AML.
Yeah, and it's important to remember this isn't just some abstract legal thing.
Not at all. It's really the practical setup that defines professional integrity and, honestly, safeguards the stability of the whole financial system.
That's right. And for professionals, especially financial advisors, compliance is, it's a fundamental part of the job.
So our mission today
Is to get a quick but thorough understanding of this legal foundation.
Yeah.
We're going to look at let's call them the three pillars, holding up the UK framework.
Which are?
The Money Laundering Regulations 2017, the MLR, then the Proceeds of Crime Act 2002, that's POCA, and also the Terrorism Act 2000.
Okay, let's unpack this. Before we dig into those specific laws and duties, maybe we should quickly touch on the process itself. What exactly are we trying to stop?
Good point. Money laundering at its core is about making dirty money look clean, legitimate.
And it traditionally happens in stages, right? Placement, layering, integration.
Exactly. Placement is getting the illicit cash into the financial system somehow.
Yeah.
Think large cash deposits, maybe buying assets.
Then layering.
That's where it gets complicated. Lots of transactions, often across borders, maybe using shell companies, all designed to hide the original source, to muddy the waters.
Make the trail hard to follow.
Precisely. And finally, integration. The money comes back into the legitimate economy, looking like clean business profits or investments or something similar.
Now, we know those basic definitions, but what's the real challenge in spotting this today, with everything being so global and, frankly, complex?
Well, the stages are the same, but the methods evolve. Detecting layering is probably the biggest hurdle now.
Why is that?
Because it might involve, say, certain types of crypto assets or complex trade-based schemes that look legitimate on the surface. It's not just about spotting someone walking in with a suitcase of cash anymore.
So advisors need to look deeper at the structure of deals.
Absolutely.
Yeah.
They need to recognize transactions that just don't quite make sense commercially, even if the individual amounts aren't huge.
Here's where it gets really interesting, because the law actually tries to tackle each step of that whole process.
It does.
Let's start with the preventative side. Those duties placed on firms by the Money Laundering Regulations 2017, the MLR.
Right. The MLR is really the foundation for preventative compliance. It sets out those strict administrative standards.
Like what specifically?
Things like mandatory firm-wide risk assessments.
Yeah.
Ongoing monitoring of client activity. And the big one, the obligation to conduct customer due diligence, or CDD.
And if firms don't follow the MLR?
Then the regulator, the FCA, can and will step in with sanctions. They see noncompliance not just as a paperwork failure, but as a systemic weakness in preventing crime.
Okay, so the MLR sets up the defenses. Then you mentioned POCA, the Proceeds of Crime Act 2002. You called it the attack dog.
Yeah, you could say that. POCA is what actually criminalizes money laundering itself. It lists specific offenses like concealing criminal property, arranging deals involving it, or acquiring it.
But for the advisor, the professional on the ground, what's the hidden danger in POCA? It's not just about doing the laundering, is it?
No, definitely not. The real sting for professionals is POCA's mandatory reporting requirement. It creates a positive legal duty to report suspicion.
A positive duty, meaning you have to do something.
Exactly. It's not enough to just not be involved. If you know or suspect money laundering, you must report it. And critically, POCA includes the concept of constructive knowledge.
Constructive knowledge. Explain that. Is that like you should have known?
Pretty much. It means that even if the client didn't explicitly tell you the money was dirty, if the circumstances were suspicious enough that a reasonably competent advisor should have suspected something was wrong, you could still be liable for failing to report.
Wow. So ignoring red flags isn't an option?
Not at all. Failure to report knowledge or suspicion is a serious offense in itself under POCA. That's why documentation of your risk assessment and decisions is so vital. It shows you are actively considering the risks.
That definitely raises the stakes. Now, what's fascinating here is how the Terrorism Act 2000 fits in. How does that broaden this duty?
Well, the Terrorism Act runs parallel to POCA, but focuses specifically on terrorist financing. It complements it.
Is that different from regular money laundering?
It can be. While laundering often involves large sums from organized crime, terrorist financing might involve much smaller amounts. Money that could be used for planning attacks, travel, materials, things like that.
So even small, seemingly routine transactions could be relevant.
Absolutely. The need for vigilance under the Terrorism Act is critical across the board, regardless of transaction size, because the potential impact is so severe. Like POCA, it requires reporting any knowledge or suspicion that funds might be linked to terrorism.
Okay, so the foundation is clear. MLR for prevention, POCA criminalizes the act and failing to report, and the Terrorism Act covers that specific, critical area of financing. Let's get into the day-to-day duties. It all seems to start with Know Your Customer, KYC, through Customer Due Diligence, CDD.
CDD is step one. It's non-negotiable. Before you even start a business relationship, you have to verify who your client is and where they live.
Using what?
Reliable, independent sources. Things like passports, driving licenses, recent utility bills, bank statements, standard stuff.
But you said earlier it's more than just checking a passport.
Much more. True KYC and effective CDD means understanding the nature of your client's business or their financial situation.
Yeah.
What are their objectives? Does the activity you're seeing actually make sense for them?
So if someone says they're a teacher, but they suddenly want to invest millions.
That's a huge red flag. You haven't satisfied CDD just by seeing their ID. You need to understand where that money came from. That inconsistency needs probing.
And what happens when the risk profile is higher from the start? Standard CDD isn't enough then.
Correct. That's when you move to enhanced due diligence, or EDD.
Okay, EDD. When is that mandatory? And what extra steps does it involve?
EDD is mandatory in specific higher risk situations defined in the regulations. It means you have to dig deeper.
How much deeper?
You need to get additional information and evidence specifically about the client's source of wealth, where did their overall assets come from, and the source of the funds for the specific transaction or relationship. And you need to understand the purpose of the relationship in more detail.
What kind of situations trigger mandatory EDD?
The classic example is dealing with a politically exposed person. A peep.
A peep.
Right.
Why the extra scrutiny for politicians or senior officials, even if they seem perfectly legitimate?
It boils down to the inherent risk associated with their position. People in prominent public functions, or their close families and associates, are seen as having more opportunities to potentially accept bribes or misappropriate state funds.
That's about the potential for corruption.
Exactly. The EDD on a PP is designed to establish that their wealth and the funds they're using actually came from legitimate sources, like their declared salary or known business interests, not from abusing their position.
Does dealing with PPs require anything else?
Yes. It usually requires more frequent monitoring of the relationship and often needs approval from senior management within the firm to even take them on as a client. It's a significant step up in compliance effort.
Okay, so you do your CDD, maybe your EDD, and you spot something that just doesn't feel right. An inconsistency, a red flag. What's the next mandatory step?
That's when you make a suspicious activity report.
A SAR.
How does that process work? Who do you report to?
The advisor must immediately report their suspicion internally, usually to a designated person within the firm, the Money Laundering Reporting Officer, or MLRO.
And the MLRO decides what happens next.
Yes, the MLRO evaluates the internal report, and if they agree their suspicion, they are then legally required to file that SAR with the National Crime Agency, the NCA. So the report goes from the advisor to the MLRO, then to the national agency.
That's the chain. And crucially, filing that SAR promptly and in good faith generally provides the advisor and the firm with a statutory defense against being prosecuted for a money laundering offense under POCA related to that activity.
So making the report protects you.
It does, which brings us to a really critical point related to SARs and POCA.
Which is?
The offense of tipping off.
Right, tipping off. What does that mean in practice?
It's absolutely vital. POCA makes it a specific criminal offense to say or do anything that might tip off the person you've reported or anyone else that a SAR has been made, or that a law enforcement investigation is being considered or carried out.
So you absolutely cannot tell the client, hey, just letting you know, I've had to file a report about this transaction.
Never. Doing that could prejudice the investigation. It gives the suspected criminal a chance to hide assets, destroy evidence, or flee. You must maintain complete confidentiality. Silence is golden.
That's a heavy responsibility. Maintain the client relationship potentially while reporting them secretly?
It can be uncomfortable, yes, but it's a legal requirement. The integrity of the investigation process depends on it.
Okay, so POCA covers the handling of the dirty money, the proceeds. But those funds have to come from somewhere, right? To really grasp AML, we need to understand the crimes generating the money in the first place.
Absolutely, the predicate offenses.
Can you connect the dots? How do things like fraud or bribery feed into this whole AML cycle?
They're major sources. Take fraud. The Fraud Act 2006 covers things like making false representations, failing to disclose information, or abusing a position of trust, all dishonestly to make a gain or cause a loss.
So if your client commits investment fraud?
The money they get from that is criminal property under POCA. Simple as that. Then they need to launder it.
And bribery?
Similar story. The Bribery Act 2010 is very strict. It criminalizes offering, promising, giving, or receiving bribes. Any money generated through bribery is illicit.
And importantly, under the Bribery Act, firms can be liable if they fail to prevent bribery by people acting on their behalf, right?
Correct. There's a corporate offense of failing to prevent bribery, which puts a big onus on firms to have strong anti-bribery procedures in place.
So the funds you might be asked to manage could easily be the direct result of these kinds of primary crimes.
Exactly. You're not just looking for money laundering in isolation. You're looking for transactions funded by underlying criminal activity.
We should probably also mention insider dealing here too, covered by the Criminal Justice Act 1993.
Yes, good point. Insider dealing that's trading shares or other securities based on sensitive, non-public information is another way illicit gains are made. It undermines market fairness.
So any advice given has to be based only on what everyone knows.
Precisely. Using inside information creates criminal proceeds, which then fall under the AML umbrella if someone tries to move or disguise them.
Okay, that paints a clearer picture of the sources. Now, managing all these duties effectively across a firm sounds like a huge task. You mentioned the FCA. The regulator insists on a risk-based approach.
Yes, the FCA mandates a risk-based approach. This means firms need to assess their own specific risks of being used for financial crime.
How does that work?
It means focusing your compliance efforts and resources where the risks are judged to be highest. Not every client or transaction carries the same level of risk.
So you might do more checks on certain types of clients or business from certain countries.
Exactly. You might assess risk based on client type, their location, the products or services they use, the delivery channel, lots of factors. And crucially, you have to document why you assessed the risk level as you did and why your response was appropriate.
So it's not just applying the same rules blindly to everyone.
No, it's about making reasoned, documented judgments, demonstrating to the regulator that you've thought about the specific risk you face and tailored your controls accordingly.
To help advisors make those judgments, what are maybe 2 or 3 key red flags they should really be trained to spot? Things that might go beyond the obvious large cash deposit.
Okay, well, a big one is any transaction or activity that's just inconsistent with what you know about the client, their business, their income level, their normal pattern of activity. A sudden, unexplained change should always raise questions.
Like the teacher suddenly moving millions we talked about.
Exactly. Another red flag is unnecessary complexity. Structures involving multiple countries or shell companies where there's no clear economic or legal reason for it. Complexity purely designed to hide who really owns or controls the funds.
Trying to obscure ownership.
Yes. And a third one could be client behavior, unusual nervousness, secrecy, maybe an unwillingness to provide requested information for due diligence, or putting undue pressure on you to complete transactions quickly without proper checks.
Right, trying to rush things through. That makes sense. And behind all this assessment and reporting, there's the vital admin side too, record keeping.
Absolutely fundamental. Firms and advisors must keep records of the identification evidence they obtained during CDD, details of the transactions, and the results of their ongoing monitoring.
For how long?
The standard requirement is for at least 5 years after the end of the business relationship with the client.
5 years after they leave. Why so long?
For tracing purposes. Law enforcement or regulators might need to investigate transactions years after they happened. Those records provide the essential audit trail to reconstruct financial histories and follow the money. Without them, investigation can be impossible.
So if we connect this all to the bigger picture, this whole complex system, MLR, POCA, Terrorism Act, CDD, EDD, SARS, record keeping, it's all designed to put financial professionals right on the front line.
That's precisely it. It imposes a proactive duty on the regulated sector, making firms and their staff the gatekeepers, the first line of defense against organized crime, terrorist financing, and corruption finding its way into the legitimate financial system.
Because when that system is compromised,
public trust evaporates. Economic integrity suffers. So compliance isn't just bureaucracy. It's an active defense mechanism for market confidence and stability.
So what does this all mean for you, listening in, perhaps, as an advisor?
It means these duties, CDD, applying EDD when needed, and crucially, SAR reporting, they aren't optional extras. They are serious legal requirements backed by POCA and the MLR.
You don't just need to know your client's name.
You need to understand their financial life, question things that don't add up, report your suspicions without fail, keep meticulous records, and crucially, maintain absolute confidentiality about any reports made.
And I suppose that position of trust you hold as an advisor is really the key takeaway here, isn't it?
It really is.
The difference between perhaps unintentionally enabling criminal activity and actively safeguarding the financial system, it really hinges on your professional diligence.
Your diligence, your documented adherence to these laws, and ultimately your ethical compass. It's understanding that just meeting the bare minimum legal requirement might not always be enough to truly combat sophisticated financial crime.
That minimum is just the starting point for real security.
A responsibility definitely worth mulling over.
Absolutely. Thank you for joining us for the Deep Dive. We'll catch you next time.